I just checked my student loans because I needed to get the information to someone, and I started with $80,000. I have been paying for 10 years. Last year, I paid $6,000 lump sum because that's really the only way to get it low. That took it down to $76,000 after I've been paying for 9 years. The grand total is I have paid $120,000 and I still owe $76,000. I think I might be late to the game learning about this. Student loans are really messed up.
Yeah, they are really messed up. So here's what's happening here. She didn't realize that making minimum payments with a high interest rate would mean her student loan balance grows as she tries to pay it down. So she's paid down $4,000 from her original balance while having paid $120,000 total for an $80,000 loan. Y'all, this is the reality of student loan. This is why you can't just make minimum payments. This is why you shouldn't get on these income-based repayment plans where it keeps your payment nice and low as a gift to you while your student loan balance balloons and balloons and balloons. It could grow 50%, even 100% if you make these minimum payments. So you've got to throw extra at it. Use the debt snowball method. Get these out of your life. Don't wait a decade or 2 decades. Take control. Be done with it forever.
We're going to get into how student loan payments work, so if you ever go to college and take out a loan, you know exactly what you're getting into. So first, let's go over the 2 types of loans. We have term-based and unlimited, and term-based loans are loans that have a specific term limit with a fixed fee every month, and once the total number of payments are paid off, the loan is complete, so you don't owe anything more. Unlimited is a little different. Those are loans that have no actual timetable, and the amount paid is up to the person paying, but the loan could theoretically go on forever without being paid off. So good way to remember this, a quick way, is that term-based, the payments are always the same, and unlimited, the payments can actually increase. So these become very dangerous if you don't handle them right. So the most common type of term-based loans are auto loans and mortgage loans, and the 2 most common types of unlimited loans are credit card loans and student loans. So again, make this note about unlimited loans. The unlimited loans have a minimum payment you must hit each month. Otherwise, the balance actually increases because you keep adding interest to the loan. So that's very important to keep in mind. And remember, we're going to focus on student loans. So let's look at some numbers real quick. And let's look at the average student loan debt payment per graduate from 1990 to 2022. So in 1990, it was about $6,100 is what the average graduate had in student loans. This number just keeps growing and growing and growing, and by 2022, the average college graduate graduates with, on average, $37,000 in student loan debt. So let's focus on that number because that is actually an insane number right there. So remember, after graduating, the average graduate has $37,000 worth of student loan debt, and the average interest rate is around 5%. So let's just focus on those because that's the most important thing right there. And the real question is, how do you pay this off? So let's look at how we are actually going to figure out how to pay this off. So first, what you're going to do is you're going to make it like a term loan, and you have to force yourself to pay it off like it would be an auto or mortgage loan. And so this is what we're going to do in this video is we're actually going to experiment around, and we're going to learn how you can set different term limits that you are comfortable with, and we're going to do it using a student loan repayment calculator. And one thing to note is that the longer in years you set, the more you will end up paying in interest. And let's dive in now. We're going to use the student loan calculator from Bankrate. So we are in Bankrate right now, and this is their student loan calculator. And this is where you can kind of experiment around and take a loan amount with an interest rate and see what your monthly payments would be, how much interest you'll end up paying when you divvy up it in different amount of years. So we're going to take, starting off, the $37,000, which is the average with the average interest rate of 5%. And let's say if you want to pay this thing off in 10 years, how our monthly is going to look, how much interest will we end up paying. So let's calculate that. So if you want to pay this off in 10 years, which is actually, that's very fast paying off a student loan, 10 years, most people don't do that. So our monthly payments on it for average yearly would be $392 per month over 10 years, which means we'd end up paying 120 total payments. We'd end up paying off $10,000 in extra interest at 10 years. 10 years is pretty short for that. Let's say if you wanted to keep your monthly payments lower, and let's say you wanted to do this, pay a whole loan off in 20 years. So you can calculate that. So you see how our monthly payments down about $150 from the $392, but our interest that we paid has almost doubled. We went from $10,000 to $21,000 in interest. And note that the principal will always stay the same because the original loan amount, that's what the principal you're paying off is. Let's say you wanted to try to get these monthly payments really low, and say you're trying to do it over a 40-year period. So this means 480 total payments. And so you're, again, notice that the monthly payment didn't actually decrease that much. It went down about $70, but look how much extra interest you would end up paying over 40 years of the $37,000. So again, the faster you pay it off, let's say you went 5 years, with the interest rate will always stay the same for whatever it was when you were in school. And so 5 years, you're doing almost $700 a month, which would be very hard to live putting $700 extra away per month. However, after 5 years, you're done and you only paid $5,000 extra in interest. Now, finally, let's just finish off with at the very beginning of the video, started with $80,000 loan, and we'll assume it's around a 5% interest rate. So let's try to pay this thing off in 20 years and just see how much you'd have to pay per month off an $80,000 loan to pay it off in 20 years. So that's where the bigger the loan amount, the more dangerous this becomes, because even in 20 years, you still would have to pay $527 per month and still would end up paying $46,000 in interest. So that is how you can kind of figure out a payment plan for yourself, you experimenting around this. So if you do decide to go to college and take out a loan, you are no longer shocked about how these payments work.